Very good evening, friends. One question that often runs in candidates' mind is which question do I need to revise on exam day morning, especially from Ind AS 109? Because irrespective of how many questions I've seen, I just want to see one question this time. So the question is this. This was asked in your November 2022 exam. So it's been a while. So pay full attention, make full use of it. So the question is, on 1st April 2021, Sun Limited guarantees rupees 10 lakh loan of to subsidiary Moon Limited, which bank STDK has provided to Moon Limited for 3 years at 8%. Interest payments are made at the end of each year and the principal is repaid at the end of the loan term. If Sun Limited had not issued a guarantee, bank STDK would have charged Moon Limited an interest of 11%. Sun Limited does not charge any commission from Moon Limited for the for providing the guarantee. On 31st March 2022, there is 1% probability that Moon may default on the loan in the next 12 months. If Moon Limited defaults on the loan, Sun Limited does not expect to recover any amount from Moon Limited. On 31st March 2023, there's a probability that Moon Limited may default on the loan in the next 12 months. If Moon Limited defaults, Sun Limited does not expect to recover any amount from the Moon Limited. Provide the accounting treatment of financial guarantee as per Ind AS 109 in the books of Sun Limited on initial recognition and in subsequent periods till 31st March 2023. So this is the question. So if you see in this question, the key concept is first one, as on 1st April 2021, a financial guarantee contract is initially recognized at its fair value. So in this case, first two rates are given. So you need to compute the interest rate differential, that is between the 11% and the 80%. So that will give you the value, the cumulative value as on from years 1 to 3 as rupees 90,000. That is nothing but the difference between 3,30,000 minus 2,40,000. Apply the PV factors on this, you will get the fair value of financial guarantee contract at inception as rupees 73,320. This is first part of the problem. Now you need to pass once, as soon as the computation is done, you need to pass the journal entry. So that is investment in subsidiary to financial guarantee rupees 73,320. So this part is over. Now moving on to the 31st March year, end of the year, 31st March 2022. So a financial guarantee marks are carried for this. So you are expected to reproduce, pay full attention. Financial guarantee is measured at a year of either amount of loss allowance and the amount initially recognized less cumulative amortization wherever appropriate. So at 31st March 2022, there is 1% probably Moon may default. So that comes to rupees 10,000. Now this or that amount we are going to compute on whichever is higher. So that is the initial amount recognized less amortization is 51,380. That is nothing but a 73,320 for which the entry was passed plus interest minus 30,000. So that amount comes to 51,385. So if you see, this is the computation for the same. And now the carrying amount of the financial guarantee after amortization is 51,385, which is higher than 10,000. So the liability is adjusted to 51,385. So now you need to, as soon as this computation is similar, same way how the entry was passed at the beginning. Now this one entry for this 31 March 2022 has to be passed. That is financial guarantee liability to PNL. So that amount comes to 21,935. That is nothing but 73,320 minus 51,385. Now moving on to the next year, that 31st March 2023, there is a 3% probability. So now that comes to 30,000. So the initial amount recognized less accumulated amortization is 21. Now this case, it is 27,037 only, which is lower than 30,000. So now 30,000 has to be considered. Now while making this adjustment, now the amount will be financial guarantee liability to PNL 21,385. So that is nothing but the carrying amount at the end of the year as on 31 March 2022, that is 51,385 minus the expected credit loss, that is the 30,000 which we computed. So that will give you the entry as value as 21,385. So what you, let's quickly recount the process flow. So first is what exactly you use, you are expected to compute the interest rate differential. So that comes to 73,320. Then immediately pass the entry, that is investment in subsidiary to financial guarantee. Then at the year end, you need to reproduce these terms this key terminologies from the standard, that is financial guarantee is measured at the year of amount of loss allowance and amount initially recognized less cumulative amortization. Now immediately go to the computation, so the amount will come to 51,385. Then pass the journal entry for the same, that is financial guarantee liability, to P&L, to bring that financial guarantee to the amount as of 31st March 2022, because it is lower than 10,000 is lower than 10,000 is lower than 51,385. So the adjustment amount comes to 21,935. That is nothing but 73,320 minus 51,385. Same way you have to do for 31st March 2023 as well. And again pass on entry. That is it. 8 to 10 marks will be in your pocket. So this is very important question. A lot of chances for your question 2A. Make full use of it. Keep going. All the very best.